not very many through our training programs. And so as we evolved and as our clients evolved and we started looking at, okay, if we want to help our women-owned businesses grow, we need to make capital more of a centerpiece of what we're talking about in our classes. And so we looked at our curriculum, we changed our curriculum, and then we started developing this continuum of services. And so the program that we launched about 5 years ago now is called Thrive in 5, and it is a very high-touch kind of program, but it had 3 goals. One was really to show our startup clients that there is a pathway, a TA pathway, to get them to that stable and growth mode. The second one was to provide another entry point for a business that's already started up, but maybe could have been running for 5 or 10 years already, is really stuck. Hasn't been able to access the capital that they need. So it's another entry point for an existing business. And the third way was really a risk mitigation strategy for our borrowers. And we find that those borrowers who do come into the loan fund that haven't accessed TA services from us yet, when we suggest very strongly that they should enroll in this program, the vast majority of them are really eager to. And so when we look at that program, 40% of the people in that program are borrowers. So you know, the question, you know, of course, is the scalability, because it's a high-cost, high-touch program. But I think the way it can be scaled is in terms of sharing what our strategy is with other organizations.
Right. We're at about the halfway mark here. I want to encourage anyone in the audience that has been having experiences with this, this whole topic, or has questions about it, definitely, just raise your hand or step up to the mic. Daniel mentioned a moment ago, the capacity issue, and used the example of a practitioner in DC and the scale of where they are relative to where they might need to be to handle. It would be the response to bank declines in DC, recognizing Capital One's only one bank. I think you mentioned, Daniel, that there were 2 key markets on Long Island that don't have adequate practitioner cover. How does the lending community rise to the capacity challenge?
Well, I think part of it is figuring out whatever we send to you, it's got to be, if the goal first and foremost is credit, it's got to be close, hopefully very close to the standards and needs of that entity. So I'll just talk about one challenge that we have that we get stuck on. Our bankers in the field, they're production people. I mean, they're salespeople. You've got them too. So they're focused on getting applications and getting, and working with their customers. They don't see all the credit. So they are the ones that may have relationships with you guys. So the dynamic which makes it all work. So we've been focused on the credit piece, which is behind the curtain, so to speak. So that's a level of complexity. But if there's a way, and this is where we've been endeavoring, and frankly we need to do a better job on this, is that there's a way that we can find those marginal applicants and streamline them so that we send those folks to Wakef or Janie or Paul or whomever. That way, we're cutting the costs of client acquisition for those folks. We're giving them a part. Hopefully, it will relate to their mission. Deal flow that's close to being ready, and then lastly, we're cognizant of the challenges and the costs of that. So when we look at our CDFI lending program, if we're going to be sending you deals, we will lend to you at good, flexible rates. We will provide some grant funding to help you meet that capacity. I know not all of it. And then we will also look to bring our credit expertise, business expertise to assist there. So that helps with CRA, but
yeah.
It's part of it. We're not just saying, hey, we're going to send you deals. We're going to help give you some capital that's going to allow you to do that. We're hopefully going to give you some money that's going to help you do that, or something else. So it's again a bigger.
Can you shed light on the CRA part and is it possible to get to a per loan dollar amount of CRA that could works for the bank and its plans and would provide adequate support to an organization like Phyllis's organization if they were playing the role of that TA provider on that decline?
That's a big question,
We're
and
here
I'm
to
not
ask
necessarily.
big
But
questions.
look, when we talk to our bankers about this, CRA is in my back pocket, but that production guy in district, he wants to help that borrower.
Right.
He's not thinking about CRA, so we get quote unquote CRA credit for the loans that we make we get investment credit for the grants that we make. We get service credit for my role on AEO and others being on a loan committee. I know Yankee's here. We've got somebody on their board. That's a part of it, but we can't fool ourselves. We'll get back to a point that I make. CRA performance is driven by lending of the institution. So my focus and my boss's focus when we sit with the head of our small business people is this is what we need to do. So we need to extend more credit. So it's a complement, but it's really a part of that. But you guys know that there's still a huge need to advocate to be able to better meet the credit demands on Main Street. You guys are a part of that. We're a part of that. The new players are a part of it. So CRA is a complement and a driver. It should be easier and easier to navigate, but it's not going to be the core driver to make this work. The bottom line is we want to do this.
Right.
And that if you operate from that mandate, it's different than saying, I've got to do this for something else.
Question from the audience?
Yes, hi, I'm Claudia Veek from Cameo in California, and we're very concerned about increasing lending and access to capital, of course. So given the significant trend of banks doing lending on the peer-to-peer platforms, and also the fact that this is a trend that's huge and getting bigger, what are the implications? I'd like to get all of your thoughts on the implications for the decline from the retail bank sector. Just get some of your creative thoughts about this. Thanks.
Well, I mean, I've said it over and over and again. I think banks want to make loans, and there's no question about it. I think when it comes to declines, sometimes from a regulatory standpoint, it's easier. The regulators and legislators in Washington have made it easier to decline loans that are on the edges and make it safer. And quite frankly, we don't really want to do that, but it is safer. And Industrial is a bank that we definitely want to make loans. And I know all other banks want to make loans too. I was with 1,100 bankers last month at an ICBA conference, and everybody wants to make loans. We don't want to turn loans down. It's a waste of productivity.
Were those bankers talking at all about the peer-to-peer platforms and what role, On Deck or Cabbage or Lending Club or anything?
Nope. They were talking about regulators and legislators. The over and over and over and over again.
Good to know what business you're in.
Seriously, I think legislators and regulators could decrease that 8,000 a day number by themselves.
Daniel, could you talk about reputational risk? I mean, that's actually, I'm sure, like an actual committee within the bank. When because the peer-to-peer platforms and the alternative lenders, is there a reputational concern the bank would have in working with them?
That's a good question, and one that we talk about, and that's part of the world that I live in. It's safe to say that the world right now is fraught with all kinds of risk. And if you're a financial institution, and I don't think there are any media here, I think financial institutions are perceived one step up from elected officials, okay? So
Unfortunately, the elected officials have also left.
Maybe not the present company here, but anyway. So it is dangerous. So we do have to look at rate, okay? So I'll give you an example, and I won't name a name. It was a group spoken about earlier today, not on deck. I'll disclose this. Gustavo's former place, Progressive Financiera. I think they have a wonderful model. I think they have a model of extending credit to a population that is not being reached. When I look at what their rate is, there's a part of me that really wants to do it because I know that population. I know where I've been around long enough. But there's a part of me saying, can I go as a steward of reputation in my company and potentially recommend and do a deal that could be wind up as part of that dialogue?
Right.
the impetus right now after the crisis is, in general, there's less likelihood to make that happen because of reputational risk.
And so, Claudia, I think there are two things just to, in response to the question we just picked up on is one, I don't think the banks are thinking a lot about peer-to-peer. They may have read about it or seen it or heard about it from some of, the leadership's heard about it from some of their folks, but they've got so many other, big fish to fry that they're not really actually working with it. And then I think the second thing you just heard from Daniel is that as the banks start to think about alternatives, they're at the top of their list is going to be the reputational risk of all these new platforms. And I think your question just really drew out an important opportunity for everyone in this room, because you're the political safe haven. If the bank is working with a community lender and the community lenders are then working with those new advanced technological products, the bank now has a very safe place for, that's a safe way for the bank to be able to tap those new innovations. It's great for you all because you're in the middle of that flow and making that happen. And that's where Connie and Tammy's Tilt Forward initiative of screening and selecting products, be it an OnDeck, be it an MMS, be it whatever products operate at scale, have the kind of regimented processes that can lead to real scale in the industry. By community lenders becoming the front end of that, you solve that reputational risk problem. So that was a great question. Thank you. Ira?
Actually, can I just say one more thing to that? I think there's nothing more bankers would want to do than to enhance new ways of lending and peer-to-peer type of environments. But we need some help because
help them, help you.
We're dealing inside of a system that is basically operating and regulating banks the same way it did 50 years ago.
Right.
And we know that the world is changing, and we want to be able to embrace and take advantage of some of the changes.
Right. Ira?
I want to just comment on this reputation thing. Internationally in microfinance, in the early days, we had some major bank groups quite interested, particularly in South Africa as apartheid was breaking apart. And we had a very senior player in one of the biggest banks in South Africa, Standard Chartered, who were very active, look at microfinance very seriously, and they ultimately backed away because of reputation risk. And that went on for a long time around the world. The banks really did not come into play at all. And where my colleagues have been predicting that the banks would downstream and take over microfinance. Well, interesting, as microfinance has matured internationally and there's much more competition and interest rates have come down to more reasonable levels. So there's been a sharp decline in interest rates all over the world in microfinance. Now the banks are coming in, particularly in Latin America, and have a very, very substantial role. And some of them are buying up microfinance, like BBVA are buying up microfinance institutions, or Scotiabank and people like that.
Look at that, there's an exit strategy.
So it's very interesting that it can happen, but I understand exactly your problem with reputation risk, and I think Mitch's ideas of the linkage between community lenders, peer-to-peer or technology-based lenders, and the banking system makes sense if you can be sheltered